The guys who can really lock in the arbitrage levels, they decide, and if shipping freight prices are high, well, it's internal, so they can absorb it, right? And they're going to make money either way. They can move the barrels, but it doesn't mean that the East-West is going to rally, because the East-West kind of has to rally with like the free market arbitrage being open, is kind of how I put it. Hi again, and welcome to today's market episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group, and today I'm joined by Martha Dowding and Vincent Wu remotely from the research team, and we have a new guest in James Brody, who heads up our Learning and Development Department at Onyx and is here to use his experience in bond and FX markets to give some of his thoughts on the macro side of things. So we've experienced yet another week of stagnation in outright crude futures, with Brent now tightening its range to around $77 to $80 a barrel. The Red Sea tension has slowly slipped away from the mainstream headlines and has not worked to stimulate meaningful speculation, and so we are very much searching for the next market-moving narrative. In the more niche futures, after volatility in the propane and dated Brent contracts, the general market is trading like it doesn't know what it wants to do. Recent moves have been localized and fleeting, with no contagion into a wider market trend. No one wants to trade in a market in homeostasis, and we've only just begun the year, so traders have balance sheet to risk and bonuses to make. You get the sense there is a building frustration in the professional oil market. So what to do in a market like this? Well, you can do your research, dive into the historical data, and try to gauge what regime we are in. It's feeling a lot like 2017, and yes, that was one of the worst years in the last decade for crude oil markets, but as always, there are pockets of opportunity in a market as complex and sophisticated as the oil market. So hopefully we can add some color to that journey, or at least give you a temporary break from the boredom. So to kick us off, Martha, why don't you give us a summary of what's been happening?
Yeah, well, I mean, you've summed it up really by saying how the market has been stagnant. We've got the graph of Brent futures up here on the screen. We've risen slowly over the week. It seemed like 80 was a real resistance point over the past few days, but then it has topped 80 this morning and then now is laying below 80, as there's just no momentum to really keep it going above there. No one really wants to be bullish. There's no risk on attitude. Looking at the CFTC report for the week to the 19th, you can see there was a little bit more bullish sentiment. So we saw a 5% addition in Brent in money managers of about 15 million barrels, and shorts decreased their position by about 2%. So, I mean, they're not massive moves, but, looking a little bullish. And then in TI, less, uniform. So bulls were taking off their long positions, about 5 million barrels, 2.5%. And the shorts were added to by 12%, 13 million barrels. So a bit of a divergence there between Brent and WTI. And just stats-wise, we saw EIA stats of 2.492 million barrel draw out in the crude stocks in the States, and it compares to the estimated 850,000 barrels, which must be doing a little something to support price action. But also Cushing saw a 2 million barrel draw as well, which is pretty significant, but we didn't really see a massive market reaction to that. And then looking into the physical, this has been really strong. I think we've got to levels of like 160 cents per barrel in the physical diff, which we'll probably talk about a bit later with the refinery margins. So on the flip side of these like quite bullish EIA stats, we have seen the dollar strength just kind of keeping levels lower. The dollar strength has been a pretty key theme this week. So this is the dollar index, and looking at the past month, we can see that we're looking at really sustained higher levels here. And this is something that James will probably talk about a bit more in a minute. Already talking about the March Fed meeting and the decreased expected interest rate cuts.
Okay, so James, welcome. Thank you for joining.
Thank you.
Yeah, you've always been very vocal about macro since you started here. I mean, for us, I think it's always about how it relates to oil. And ultimately, I think it's fair to say in 2023, particularly the second half, there wasn't a hell of a lot of conviction in oil markets and the professional side, I would argue. But there was a hell of a lot of swinging to and fro from money managers. And of course, a big part of that is their risk parity trading, right? Their portfolio adjustments. And they are evidently quite moved by macro data, macro sentiment. So just to lead on more of that, it's, 2023 was meant to be the doomsday year, for macro. We were meant to get recessions, and that was a lot of the talk, and it didn't happen. So dollar strength to start us off, but just in general, could you give us a summary of, I guess, just the macro, and then maybe a bit into how it feeds into oil, or at least how the macro traders are starting to feel and move money around?
Certainly. Well, although last year the market was talking about a recession, the overnight index swap and the Fed funds futures weren't actually pricing any cuts into the market. It's only this year that we're now seeing that aggressively priced. Currently we have 132 basis points of cuts priced into the curve this year in the US. What's interesting is the market's looking at the March meeting. Do they or don't they cut there? A week ago, there was an 80% chance they would cut. Now it's down at 42%. We've had slightly stronger data in the last week. Mm-hmm. And it's typically where it's sort of at the end of the cycle. We're getting weaker data, but the odd flash of stronger data. So if we look at in the US at leading economic indicators, they've been in contraction for 21 months. The ISM manufacturing survey's been in contraction for 14 months. Yet we still have strong employment. The unemployment rate's at 3.7%. It's only just ticked up from the low of 3.4. So that's in a good place. The inflation's coming back to level, coming back to target. Certainly, in fact, in Europe and the UK, it's likely that inflation will be back below target in the second half of the year. China, we've actually got deflation. We've got CPI there at negative 0.3% and PPI at minus 2.7% year on year. And interestingly, China's exports are down, export prices are down over 10% year on year. So that will have some offset against what's going on in the Red Sea with prices ticking higher there. On the inflation side as well, rents are coming down, second-hand car prices are coming down. So inflation now is very much secondary data. The manufacturing's very important. Especially actually if we look at Germany, industrial production's currently still 14% below pre-COVID levels. But to me, the critical point is employment. Although it's still very strong, we are seeing early signals of weakness. We're seeing the jobs being created are low-income jobs. More people are being forced to take second and third jobs. We're seeing part-time job losses going up aggressively, which is typical precursor to full-time layoffs. But probably the most interesting one, ISM Services Employment Survey came out just an hour and a half after payrolls, and that had collapsed from 51 to 43.3. That's the sharpest decline outside of the financial crisis and COVID. So forward-looking indicators suggest that employment is going to fall, unemployment will tick up, but we haven't seen it yet. So for me, the key data over the next, up till the March meeting, will be around employment. We had a really strong consumer sentiment data last week. So the consumer's still happy. They have jobs. We have, of course, equities at all-time highs and breaking higher. But the real key for the central bank is when employment starts to fall.
So it still doesn't paint that clear a picture, because again, we had a lot of, just thinking purely sentiment, kind of bearish sentiment come from the macro all year last year, and it wasn't like the market was overly bullish on oil either. So it's similar right now, but even more in a tighter range. Is there anything, can you see the argument for a lot of risk coming in to oil from investors, from more macro related investors?
Certainly. I think as we see money move out of the equity market, I mean, an interesting statistic, in the last 6 recessions, the low of the S&P is 11 months after the first Fed cut. So right now, equity investors are saying the Federal Central Bank will cut rates, that's good for equities. But actually, historically, it's very bad. And if we go back to 1970, then every recession, the average is the S&P bottomed 195 days after the first Fed cut. So I think when we do start seeing the Fed cutting rates, then we'll see money moving out of equities, and then commodities is a typical place. If you look at the ratio of equities to commodities, commodities are very cheap. We typically see money flows back into there. And I think gold would be a big beneficiary as well.
The relationship between like an inverting bond yield and recessions. And I mean, the last one, I remember it was really well talked about in 2019. Before we got to 2020, but obviously the pandemic was the biggest driver of that. So the track record of, the inverted bond yield causing recessions is kind of intact, but at the same time, not really. Well, the last one wasn't clear cut that was essentially the lead lag indicator. It didn't predict a pandemic, right? So is there a case to say, if everyone's expecting it, and also I'm just using the logic of like, we're expecting rate cuts because the central banks want to stimulate the economy again, the inflation's under control, everyone wants a thriving economy as long as inflation is manageable, and power and gas markets are looking a lot more stable, a lot of storage. A lot of the reason we got inflation was printing money, commodities rising, and we didn't get this like promised recession last year. Is there not a case for saying it could buck the trend? And just because we're going to expect rate cuts down the line doesn't mean we have to get a flow of money out of equities, right? Or it's just a historical thing. Is there not an argument to say that, or do you think people are very blindly going to be expecting this and it's going to kind of follow suit like a kind of self-fulfilling prophecy?
On that, I think the 2s 10s curve inversion and saying that predicts recession, I think that's very vague. I think what's obviously a far better prediction is where the market perceives interest rates to be, which is the overnight index swap. But I agree, because the market perceives it. In the last week, we suddenly had much stronger consumer confidence data. Retail sales in the US was stronger. So if anything, the market's starting to pull back and saying maybe we're not going to get these cuts that are priced. But in Europe, on the other hand, I think the data's considerably worse. We had a far weaker retail sales in the UK. It's down 3.5% month on month. Industrial production in Germany, which is the strongest economy in Europe, is falling hard and significantly below pre-COVID levels. So I think the market's pricing almost exactly the same cuts from ECB and Fed. It's 132 points from the Fed, 134 points from the ECB this year. It's far more likely we'll see the ECB move first and have to move harder. Employment's higher, industrial production's far worse. And it's quite a chance that if unemployment doesn't tick up, then the Fed can hold. Because what the central banks don't want is to cut too soon. Their credibility is in tatters after saying inflation will be transitory. So I could see the Fed, without inflation ticking up, actually being on hold at these levels for longer. Where equities get interesting is they are historically expensive levels. But at the moment, they keep going up. So the money keeps chasing them.
Yeah, and I guess the inflation part of it as well. I mean, again, inflation, a lot to do with it was commodities, right? You have to say. And then kind of things compounding from there. I don't think you have that this year, as not nearly as much of the risk as you had in 2022, primarily because even in an extreme scenario, we've rerouted trade flows in the West, terminals in LNG and replacements for Russian gas have been kind of very much been taken care of. So it doesn't feel like we have the risk of this major shock we had, and therefore, a huge surprise on inflation from commodities. Obviously, it could still happen, but do you think from an investor mindset, this is the key part, right? We were looking at the macro money moving in and out of the CFTC report, in and out of Brent and WTI. Do you think as an investor, we're looking at hedges for inflation on the back of this economic scenario, or do you think that's over? I
think that's over now.
Yeah.
Yep. There was a report came out from the ECB just a couple of weeks ago highlighting that the bulk of the inflation over the last 3 years was purely down to supply chain. And yet what they've done is they've raised rates which attacks demand, consumer demand. But as you say, it looks like supply chain's being resolved. We're seeing more onshoring again. Business is moving back to the US, or Mexico in the US's case, moving away from China. We're seeing China exports falling aggressively. So I think there's far less concern about inflation. Even as you said earlier, you mentioned with the events in the Red Sea, the Houthi rebels, that's what the impact that will have on inflation is very much secondary headlines.
So you could argue that it's unlikely to get a lot of money going into oil contracts basically this year from an investor perspective. Could you summarize it like that, or is that too vague?
I would think so, unless we start to see flows out of equities. And typically if the Fed start cutting rates, that's when we start to see what we call in the financial markets called the risk off. We see money move straight out of equities. There's already a lot of money in bonds. The bonds have already pricing these aggressive cuts. So where does that money go?
Apparently recently, the corporate bonds market is particularly on fire at the moment. So yeah, I can see that logic. But just buying oil for the sake of it, just because there's nothing else to buy, seems a bit extreme. But I see your point about the gold argument. You think gold could be an outperformer?
Gold would definitely be an outperformer. There's a real key level at about 20,075. over the last 4 years, it's got to that peak 4 times. So it'd be a quadruple top, be called a quadruple top. And if it breaks above there, and it's very close at the moment, if money is starting to look for a place to go, if inflation's low, if equities are falling, bonds have already had a significant move already. Where does money go? Well, asset managers, it's already been talked about, will go into gold. And if it breaks above that level, it becomes self-fulfilling. All the financial media TV will be talking about it. The retail money will chase it. And we get
back in
move.
fashion.
Yeah, just like 2011.
What about Bitcoin? The new gold. Well, but at the end of the day, you could say it as a searching for new returns in a way. And I think that's actually quite a good way of summarizing the state of the oil market as well. We're trying to find areas to search for these returns. And if you're not getting it in the flat price, you've got to go and look for different things. And there are quite interesting correlations. A lot of people trade gold versus oil, for example, and there's plenty of things. But James, that's really interesting. Thanks for that summary. So I guess moving to a bit more about what the niche futures are telling us about the underlying oil market. Vincent, what's going on with, let's say, Brent Dubai? So West versus East type crude.
Last week we touched a bit on the movements in Brent Dubai, and certainly over here in Singapore, it is really very much the talk of all the crude traders, both physical and paper, because there was a massive upwards move 2 weeks ago, which followed the upwards move in the North Sea crude market as well, dated Brent. This is quite a surprising one, as Brent Dubai, the front month contract, jumped by over 50 cents to almost, so as seen on the screen here, jumped up from around 10 to 20 cents to upwards of $1 per barrel and over the last 2 weeks. That was a very quick and rapid rise, and it seemed like $1 per barrel is very much the resistance point, which following that, the past 2 weeks, which we've seen a small gradual decrease / correction lower. So what was the reason for that? Well, through our counterparty data, we were seeing there were some Chinese flows, Chinese players, Chinese majors buying into specifically, for example, the February / Q2 box, as well as a lot of existing shorts were forced to stop out of their positions. It was something that we've seen over the past year, where we've seen a lot of market participants add their risk into Brent to buy contracts. Open interest has always been above the 5-year average, exceeding the 5-year maximum. So there's a lot of saturation towards the sell side, and in events like these, in retrospect, it is unsurprising that a lot of shorts would have used this as a liquidity event to exit their positions and take profit. And what was really interesting was from our COT dashboard, where we were seeing we're identifying the market entry level for short players. On the 12th of January, this is where prices exceeded that level, which meant that the net short market was out of the money, and therefore this would have at these levels, looking at market psychology, it follows that a lot of shorts would have thought, okay, it is time to exit their positions, and this would have exacerbated any upwards movements. But now at these high levels, we're seeing a gradual move downwards. So overall, Brent Dubai, typically it just goes down slowly and then rises rapidly before slowly grinding down ever so much again. So it does seem like very much a matter of back to normal programming over the past week.
Yeah, it's a good summary. I mean, generally speaking, people rely on the Brent Dubai as a benchmark for either light versus heavy crude, sweet versus sour. But I think the West versus East is a good way to put it at the moment, because people still expect this to be weaker or even be negative like it was last year, because OPEC are in the middle of the cut. But to get a market being wrong, ultimately it's just rising, as you said, to do with counterparty positioning, being out the money. But it's frustrating for people, because ultimately this is yet another indication that the market is moving against the fundamental outlook, and a lot of the suggested trades at the beginning of the year because of the Houthi situation was buying Dubai spreads, which again weakens Brent Dubai, and it just hasn't panned out. So it's just yet another example. It's a difficult market out there, but ultimately, if you're going to do the obvious trade and the market isn't really performing, isn't on a wider trend, then you're just joining a herd, and it's very likely to happen. It's not ultimately surprising if you digest the market from a positioning perspective. And what about refinery margins? Martha, do you want to take that one?
Yeah, it's been an exciting week in the refined products. But starting off with the physical dated Brent, it's been a really strong week in the dated market. So there's been less WTI Midland available in Europe coming from America because there's been more demand in the States. It's been a real freeze over there, bit of a cold snap.
Freight high as well, right?
Yeah, and really high freight for that route. And on that same note, the cargoes are stuck in the Med as well because of the whole Houthi situation. But it's interesting to see that this is all really localized strength at the front of the curve. The physical diff has risen to 160 cents per barrel, which is just outright quite high price. But it'll be interesting to see whether this kind of continues due to its being such localized strength, and whether the freight rates will continue to be so high.
So when we talk about localized strength again, so you see the Houthi situation, you look at the freight prices, you look at, a very reasonable, basically conclusion that the North Sea or the local refinery crude situation will be undersupplied because they get a lot of their crude from imports. So it makes sense to be bullish, but ultimately the flat price didn't perform, and even the Brent spreads, the time spreads, which is the most accessible way of trading kind of underlying physical in the forward curve for investors and financial players, it just didn't really perform. You have to have access to the dated Brent contract and the very prompt of the dated Brent contract, which did see that material move. And this is just yet another example of there is a lot more going on in the oil futures than kind of the generic observer usually sees, with something we hope to fix, keep going on about that. But the point is that, it's again, I can understand frustration because you expect the market to perform, but you can see that it actually has. It's just a localized thing. And I don't believe that the market is, even the people trading the North Sea, I think they can see this is about a temporary kind of imbalance. The US situation should clear up. We should get freight should ease. As I said, it's kind of slipping away from the mainstream headlines. Insurance premiums should go down. So in order for it to hit the time spreads, in order for it to hit the forward curve on the futures market, you need this to affect oil kind of 2 months forward, and then sustainably so. So I think generically people just don't expect that, don't believe that to be the case, and it could shock us. And again, the market getting a bit not lazy, but is in a little bit complacent on that. I mean, the market came in short dated Brent contracts, and that's probably a big driver of why we rallied so much in the prompt. So again, if people are being complacent about this being a long sustained impact, then it could actually impact the Brent time spreads going forward. But the actual margin level, Martha, and what the products are doing? Yeah,
so there's been a week-on-week increase of 53 cents per barrel, and this has been a product-driven rally. Although crude has been strong, it has not been as strong as the products. The strength has been amplified in gasoline and gasoil specifically. So gasoline, we'll start with that. Gasoline complex internationally has just been strong. We spoke about it last week. This is like a safe contract for people to put length in at the moment because it's so seasonal, because they know that the summer strength is coming. So it seems that they're very happy to kind of put length on, and the front spreads kind of.
But we did also talk about it being historically high levels already in the summer contracts.
Yeah. But we're still seeing, improvement here. The front spread is just on the screen right now. The levels that it's being dragged up by are very, very high, but we are still seeing support. So we've been seeing refiner buying in EBOB and 92, so in European and Asian gasoline, which is indicative of the refiners and blenders as well, believing there's going to be greater strength for further down the curve. So therefore they're taking some of their hedges off as natural sell side players. So looking at the front of the curve, it's actually really interesting to kind of break it down by counterparty. So we're seeing, of course, as well as all of the natural like trade house buying in the EBOB spread and cracks, we've seen actually refiner and therefore like blender buying in EBOB, which is European gasoline, and 92, which is Asian gasoline. And this is a pretty bullish signal because as these players are naturally on the sell side, they're buying the product now because they believe it's going to become more expensive later.
Do you think, I mean, it doesn't necessarily, I know what you mean, but it can also just mean they've profited from their hedge.
Winding down hedges.
So it depends from where, I guess, but that's probably, I mean, it's unlikely because it's been rallying. So maybe they're actually just concerned that they're going to miss out on the strength in the prompt and they're willing to take the risk on the physical.
Yeah, really.
So you're right. It's probably quite bullish on that front. So maybe they're seeing something in the cash premiums and the physical market that indicates they got a lot of confidence.
Yeah, it'll be an interesting thing to monitor, see if how much they can wind down their hedges and how much they're going to, be unhedged in the market. It's a risky place to be.
Yeah, you're adding, refiners buying is adding, effectively adding length into the market, even if they are just flat, because if you don't have that sell side volume in there, then it's kind of, they're almost implied long.
Yeah.
So that refinery selling could come back at some point. And with the speculative length already long, this is a classic cycle. But it's quite unusual to see the refiners do this. So that could genuinely be bullish for now, but also kind of maybe overextension in the near horizon.
We'll keep monitoring that. And then on the heavier side, looking at the gas oil, this has seen a pretty substantial week-on-week improvement, dragged up by the futures. So this is coming from like a whole range of places, but just linking it to the more kind of fundamental reasons, we've seen really heavy selling in the gas oil East-West. From the beginning of the year, it's just been like absolutely obliterated, down past -30, which was normally a very low level, and now we're looking at -36. This is all stemming from the troubles in the Red Sea. And so just like statistically, 58% of European gas oil does come from the east of Suez. So that's like 24.4 million barrels a month on average. And so this freight is having to go 10 extra days around the Cape of Good Hope. The AG Europe bound loadings down 55% from December to January. And this is like a really substantial, this has had a really substantial impact on the East-West. As you can see, as the East-West is so weak, this is of course driving European strength. But on top of that, we're seeing the inventories. This
reminds me, because I when I was trading gas, it was probably like 8 years ago now. We still were trading slightly higher sulfur contracts in gas oil, but the East-West was just getting obliterated just like this. And it's tempting to think, okay, it's opening up the arbitrage. And so, yes, everyone's rushing to, fulfill that arbitrage. It's all pointing to Europe from the US and Asia and Middle East. And yes, they go around the Cape of Good Hope, but there was also talk of people kind of cutting through, getting icebreakers going around the top of Russia, all in this big race. And it was a huge moneymaker for a lot of the trade houses. But at the same time, if freight goes higher, then this differential can go lower. And at the time, probably not as sophisticated as we became later on. And it was, a case of buying what was cheap and thinking it would rebound. But the simple logic was, but the lower freight can go, the higher freight goes, the lower this differential can go. And the freight situation was poor, was dire, a bit like it is right now. So actually the smart money is actually selling this differential because you actually, in a market as small as kind of Sing distillates, you kind of lack buying quite quickly if there's no arbitrage open. And so it's kind of gapping down. And then also what we saw was the regrade. So the Kero versus Sing distillates, that started to explode. And again, people were pointing to like fundamental justifications for this, but it was the only way to get short gas oil. So coming in the morning, you're kind of net long, and you just trying to find any bid, and any bid that does come in gets hit straight away. So people were just buying the regrade to try and get some exposure there. So you're getting like all-time highs on the regrade. But again, classic. People always say, "Oh, it's because the jet market's so strong." It's like, well, no, it's because of the way the curve works. But having said that, there are probably more fundamental justifications for Eastern jet fuel to be strong. But it looks very similar. So I think it's tempting to say, this is cheap, lock in arbitrage levels. But the guys who can really lock in the arbitrage levels, a bit like propane, and Luke was on this at the end of the year, our propane trader, talking about this. If you own the ships, especially these trade houses have, ship subsidiaries, chartering subsidiaries, then they decide, and if shipping freight prices are high, well, it's internal, so they can absorb it, right? And they're going to make money either way. So they can move the barrels, but it doesn't mean that the East-West is going to rally, because the East-West kind of has to rally with the free market arbitrage being open, is kind of how I'd put it. So it looks very similar. So we shouldn't just assume that's going to bounce back. Not that you were implying that, but and then if anything, as you say, it's supporting Europe as well continuously.
Yeah, so European strength is saying, fundamentally, Europe has strength outside of this relationship. I, for one, wouldn't be... I think that the East-West has lower to go. As well as these East-West related reasons, the inventories are low in the ARA, and they're not getting the product, and Europe has been really, really strong. We've seen some refinery outages over the past week or so, and India not exporting as much gas oil as they have done. Refineries prioritizing jet over diesel, and also purely financially, the Feb-June spreads of the gas oil has broken out of the triple top, so it could have even more room to rally there and kind of lift the whole curve. It's a really interesting one to watch here.
Well, maybe some life. This is a bit more of a macro contract, so this is actually maybe a good one to kind of stimulate things in your market. So that's super interesting.
Yeah.
Okay, what about kind of Googling oil, like big headlines this week? Vincent, do you want to kick us off with that?
So a few things on Googling oil. So a couple of headlines here. So I'm sure many of our viewers would have heard about the Ukrainian drone attack on Russian energy infrastructure. There's been a few over the past week. One of the more recent ones was at the Ust-Luga complex. It's a fuel export terminal in the west of St. Petersburg in the Gulf of Finland. This is the third attack over the past week, and it's just a reflection of the wider war between both sides targeting each other's energy infrastructure. So operations were halted for a few days, and the export terminal is one of the main naphtha suppliers towards East Asia, for example, China, Malaysia, and following the news, naphtha cracks quickly rose, but also fell just as quickly as news of resumed operations surfaced. It's also worth mentioning that the export terminal is a supplier of jet fuel for Turkish Airlines. Another one was just reporting the oil prices. So oil creeping up as geopolitics counter demand concerns. So that was a major one, potentially related to the geopolitical risk premium, as Brent crude flat price went up to $80 on Monday's market open, which has been attributed to attacks on Russia energy infrastructure as well as existing Red Sea concerns. But this, as Martha touched on earlier, this $80 level proved to be a key level of resistance as prices failed to climb higher. So overall, flat price seems to really be a non-story with traders looking for relative value trades elsewhere in the more niche part of the oil market. One more we got was China defies sanctions to make Russia its biggest oil supplier in 2023. So it was mentioned from Reuters that Russia overtook Saudi Arabia to become China's top crude oil supplier in 2023. It wasn't so surprising because Saudi Arabia, Aramco was raising its OSPs, as well as the fact that sanctioned Russian crude oil is much cheaper, as you could see.
Saudi have lowered their OSP, right? We were talking about that's a big headline before. The Saudi.
But over the course of last year.
Yeah, so this is probably, there's slightly lagged information. Maybe the Saudis were more on top of this, and then maybe it's a reaction to exactly this, because China is the staple buyer of Saudi crude, and probably a very key them and India. So I think Russia creeping in like that, it's looking more and more like a market share war could be around the corner. So I think that's a very relevant headline.
Yes, and there's one more regarding the ADM headline. So one of the ABCD of the agricultural commodity trading firms, Archer Daniels Midland, its shares plunged by as much as 40% on Monday as its CFO was put on administrative leave pending ongoing investigation regarding certain accounting practices and procedures. So ADM is one of the major traders of commodity trade houses for grain and oilseeds, with operations in nearly 50 countries, and in 2022 had over $100 billion in revenue. Because of the recent headline with regarding the CFO, its release of Q4 earnings have delayed, really, with a lot of investors really skeptical about the company and its future for now. And as many commodity traders are aware, recent collapses of Noble Group and Hin Leong over the past decades were on the back of accounting irregularities as well.
This looks like it will be hedging losses, which are not hedging, like hidden speculative trades, rogue trading. Again, it's such a common theme in big companies that kind of disguise their hedging mandates with just gambling, basically. So we don't know, of course, but accounting practices, yeah, it's that would be my guess anyway. So you're right to bring up the Hin Leong thing. So yeah, that could be pretty serious. So yeah, any more thoughts on that, Vincent? Knock-on effect. I mean, it is agriculture, but that's not to say there can't be knock-on effects into oil.
No, I think its relation with oil would be more about the fact that there has been that people are now aware of these certain practices, and potentially these are merely the ones that have been caught over the past year of 2023. Maybe not sure if I should mention this, but people might think over the oil market with a lot of trading houses, there could be speculation of what traders might be hiding as well, of course. So not directly related to the commodities, the actual markets per se, but more about the investor confidence and how the public perceives this industry.
Yeah, it's a knock-on effect to it's credit lines, it's banking lines, it's the infrastructure behind, and you don't want to see this because it's a big critical service that these trading firms provide. Without all this, we don't get the commodities we need for everyday lives. So you don't want to see it happening. But let's hope that's not a huge deal then. We've got our kind of poll part now, and we did one on what's the biggest driver of oil markets right now. This was on LinkedIn. 64% of people thought it was the Red Sea, and 20% thought it was deflation, and not many people thought it was the Texas freeze or market stopouts. But yeah, that shows you kind of where people's heads are at. But ultimately, it's kind of yin and yang, right? We've talked a bit about dollar strength and macro situation versus the Red Sea, conflicting headlines for driving sentiment. And I think the CFTC report of the money managers' flow in and out of oil is basically perfectly in line with that. It's like it's range bound because there's conflicting things to be driving the market. And I think the professional market is just searching for opportunity in the minutiae. So that's kind of pretty clear there. Why don't we finish with a trade idea?
Okay, well, we talked about possibly being long gold. We talked about earlier, that's a longer term trade when it closes really above the 2080 level. But on the shorter term, we had the Bank of Japan out this morning, and the Governor Ueda was a more hawkish tone. The yen strengthened, and the yen's been really beaten up in the last really 4 years, primarily on interest rate differentials. While other central banks have been raising rates, of course, the interest rate differentials have widened. But what we're going to get now in certainly at the end of Q1 into Q2 is Bank of Japan potentially raising rates and moving away from negative rates.
That'd be massive moves. They've not done that for a long time, right?
Absolutely. Still at negative rates, and other central banks will be cutting rates. So one of the many drivers, the primary driver of currencies is interest rate differentials. Yeah. So I'd look to be possibly going long yen here, particularly against the pound and the euro. Less so against the US because, as we said, the economy is slightly stronger until we really see that the Fed will be cutting rates.
And do you think that's it's not been looked at much? Do you think that'll be a surprise for the market?
The market's traded at long term. They've been selling the yen, particularly the CTAs, the algorithms, trend following. And we've seen some asset managers talking about it quite publicly, that they've been in the last month, they've been starting to buy yen. the yen strengthened, and the last couple of weeks it sold off again. But that's potentially a longer term trade when we see these central bank rate cuts.
This is James Brody, asset management.
Yeah.
Great. No, it's an interesting one. And you never know with these things. I mean, foreign exchange is probably something we don't probably talk about the least, but it does feed into oil demand and oil behavior. I mean, you need to buy oil in dollars, but obviously people's local currency is hugely impactful on the demands, particularly India, a huge consuming nation, and Japan, of course, as well. So I think that is relevant, and thanks for that. And thanks everyone out there for listening. We're going to leave it there. Just a quick note, we're loving seeing that our viewership is going up. If you are interested in how the US election might play out on oil, bits of experience about Lehman Brothers with a collapse there, Goldman Sachs, crypto. We had Jonah Van Borg on our podcast on our leadership series. Super interesting guy, super interesting experience. So please make sure to check that out. And also please remember to like and subscribe. It really helps the channel. And we'll leave it there. See you next week for another market podcast. Thank you.